Good afternoon, everyone. Caeli Ridge here, Ridge Lending Group. I come to you today with a few thoughts, comments, ideas. I was thinking about this yesterday after a conversation I had with an investor client, of course, and I wanted to share it and just under the precipice that what might be obvious to me isn't necessarily that obvious to you guys. You're not living and breathing and eating and sleeping this stuff. You're not looking at it all day, every day. So I thought that it might just be useful for you to kind of hear it from my perspective. A lot of you in the conversations that I'm having are mentioning to me that you're kind of hanging out for those lower interest rates. And while I understand and I respect it, even if I don't necessarily agree with it, I just wanted to bring to your attention a few counterpoints to waiting versus jumping in and investing, even in higher interest rate environments. So when we talk about the long term, let's talk about long term, even midterm rentals, where you're going to have a more stable tenant that's there for longer periods of time. Those individuals are not buying properties right now for sure. The renter certainly is not in a position where they can qualify for the higher interest rates. So they are not in the market to purchase properties. However, they are going to have to figure out what their housing requirements are, right? They have to find a place to live. So they're going to continue to be renting. And while I accept and agree that your returns are going to be less for you on that end of things because you have the higher interest rate, your cash flow isn't going to be as robust. Maybe it's 100, maybe it's 200, maybe it's 250, maybe it's $50 a month, whatever it might be. Very few of us investors are retiring or getting rich, if that's a term that you would use, on the monthly cash flow on a few properties, right? Whether that's 300 or 400 or $500 a month, or more modest in the new expectation of cash flow that the higher interest rate environment that we're in now is producing. So knowing that, are we going to wait until whenever, the end of this year, middle of next year, the beginning of 2015, whatever it might be, where interest rates drop? And remember, everybody, rates are going to drop a lot slower than they went up. Okay, so by that accord, you may be waiting for a long time. In the meantime, what I think you're going to be missing out on is trifold. Maybe there's a fourth one in there. I'll try to remember as I'm going through this. First, you're appreciating your rents annually. So whatever you're losing today in the cash flow that maybe you were expecting a year or two or 5 years ago, whatever, you're going to be appreciating those rents, or you should be appreciating, increasing those rents annually. Talk to your property manager. Every market is going to be different. But I would say on average, national average, rent appreciation is somewhere around 5 or 6%. So figure out what your gross rents are today, add 5% for the next 2 years or 3 years or whatever, okay? And see how much or how long it's going to take to cover that spread or that expectation of cash flow that you had prior. The second thing is that the home appreciation, even if you're purchasing in a market where it's flatlined. Maybe it's going up just a little bit. There's not very many markets that we have left out there that are really have an upward trajectory by any significant margin. I think that we're probably light, straight, and then there's plenty of markets that are coming down the way that we had predicted that they would. And then finally, you've got your tax benefits. So for those of you that have, let's say you're a higher income or wage earner, and I know that you're getting hammered in the amount of income taxes that you're paying, you need some of those deductions. Well, the two things. One, the higher interest rate that you're paying is more interest that you're going to be deducting on that Schedule E. The loss in cash flow that you're going to receive at the higher interest rate, there's also going to be other deductions that you're going to be taking organically anyway, depreciation, management, taxes, insurance, all of the standard stuff, and maybe maintenance, et cetera, et cetera. Those deductions are going to create a windfall for creating less in taxes that you would be paying otherwise. So couple all of those things together when you're thinking about it. So for those of you that are sitting on the sidelines, waiting for interest rates to come back down, while I respect that, I don't agree with it. Am I saying that you're supposed to go out and get a property at a 6.5% or 7% or 7.5% interest rate that is a negative cash flow property? No, not necessarily. And for most of you, absolutely not. For some of you, that probably makes sense. I know that for me, I could probably use that loss given, the taxes that I pay annually. Don't get me started on that. Anyway, I think you get my point. That was my message. I hope that it was received in the tone that it was intended. As always, we are here on standby. If you need anything, give us a call, shoot us an email, check out our website, info@ridgelendinggroup.com, 855-74-RIDGE, 855-747-4343. If you want to get in touch with us via phone, we're here. Talk to you soon.